All right, so I'm here with Timon, our head developer and resident genius. He's way smarter than me. And we just want to go through our algo results for yesterday, which was undoubtedly today is the worst day in crypto history, right? Undoubtedly. So yesterday we managed to eke out a small profit while we were, about half long, half short?
Yesterday we were pretty much all short already.
Okay.
The day before we were mostly long.
Wow, and we still eked out a profit even though we were mostly long.
Yeah, because most of those longs were in profit. So then when we flipped short, we took some profits on those long trades, and then we made a profit on the way down too.
Neat. Share screen and knock yourself out. I'm interested to see how we went today. I'm fascinated actually, because this is really like we've been running. How long have we been running this thing for now? Like three months, 4 months or something?
We started with early beta in mid-July.
Okay.
And then really in earnest since mid-October.
Okay. So, we're running the full quota of positions now. Whoa. Oh, no, that was when we dumped small money into it. Okay, so we're only running it with a little test account. And it went up.
We were running it with 2Ks here, and then we added a bit more money here to 5,000.
Yeah, so we're just running it with $5,000 just to see how it goes, see how it handles things. And yesterday, pretty good, 1.9% for the day.
Yep.
And we're running it at 25% volatility target, right?
Right. So yesterday we were 683.49 exposure, with the rest sitting in cash.
So we're not using any leverage, the opposite of leverage, where we've got hardly any positions, right?
Right. Most of the capital sitting in cash.
Wow. Very interesting. Because I mean, I've run systems like this on futures markets, and you're nearly always in leverage because there's so much lower volatility, right?
Right. But in crypto, for most of these coins, the volatility is like 150% a year.
Mm-hmm.
So if you're targeting 25% volatility, then most of the time a lot of your account is going to be sitting in cash.
Exactly. And 25% is like conservative, like normal investor thinking. It's not like crypto shoot for the moon kind of thing. So we would up the volatility if we wanted to run that kind of program.
Exactly.
Cool. Let's take me through it. Let's see what we got today. It's your story. Tell it.
Okay. We can look at our positions.
Okay. So I don't see anything that's not short, and I don't see anything that's not in profit.
Today, everything is short. What are some losses, but they're like $1, $0.50.
Interesting.
These are our losses for today. And if we go to one, we see our winners. And then clearly the winners massively outsize the losers.
So this is interesting. This is this classic thing of positive skew systems where we're playing for outliers. And essentially we're trying to avoid, we're trying to just be willing to wear these tiny little few cent losses here and there, or more often than here and there all the time, in order to get the big wins on BitPerp, HolyPerp, TRX perp, FTT perp. Wow, those are pretty good things to be short.
Yep.
So it really is like a 80-20 rule. Like those four positions are probably 80% of the profit, right? Out of the 80.
Yeah, exactly. Like if you see we have a $50 profit here, then if we compare that to our losses, like the biggest loss is $1. So the biggest win is 50 times bigger than the biggest loss.
I mean, I don't think we can overstate how interesting this is. Like, we're only doing it with $5,000, but like, this was, our goal was to build a positive skew system that benefits from uncertainty, that when the world goes to shit, we're going to be fine. And that's that's the big problem with crypto, right? Is when it goes to shit, you're not fine. But we've actually built a thing that when crypto pukes, you're actually fine. To me, this changes the game. It changes the game, that you don't have to be scared of this bullshit happening, because history's told me that this shit has happened again and again and again. It's probably going to happen again and again and again.
Yep. And when it happens, we profit. So as you can see, this was like all trading range territory.
Yeah.
And then here the market started rallying a little bit. And then here they started just selling off aggressively. And as you can see, that's our biggest jump in equity curve when the markets are crashing.
So when the market was going sideways, how much did we gain or loss? So we were only running a $2,000 account then, but did it hold okay? Because this is a trend following system, right? Like, with no trends, it shouldn't make any money. But
well, here's the trading range. The equity curve is basically flat, just
from 2003 down to 2004. So that's down what, 2% in a month.
Yep.
Yeah. Very, very interesting, man. And how are costs looking?
Today's aren't counted yet because I count them at midnight. So total cost yesterday was 2.5 cents.
Really? Like that low?
Yeah. On the second, we actually had negative costs because we made a little profit on funding.
Okay, so our average turnover looks, just eyeballing it, looks to be about $50, right?
Yep.
So $50.
Probably more on some days. It can be $100, but yeah.
So
like yesterday it was $100. So 2.5 cents on $100.
So between 2.5% and 5% a day turnover. So at 2.5%, 0.125, 0.365. The turnover. So at $50 a day for that size, that's a yearly turnover of about 9 times, which is pretty good considering the slowest trend following turns over about 7.5 times. Carry turns over about 10.5 times a year. And a fast trend following, like a 2.8 crossover, will turn over 50 times a year. So that's actually really, really good compared to what I was expecting. Yeah. So what are our positions looking? So what other metrics have we got here? We've got positions and portfolio. I've already seen that one.
Well, we haven't implemented that many metrics in the dashboard yet.
Gotcha.
We can look at some positions and see how they behaved.
Sure. Let's look. Let's look at Sol. I'm interested in you.
It's a little bit slow because the database is in the data center, but I'm running this on my local computer.
Oh, you built out new charts.
Yep. So let's see, on 6 November we were long and 8 November we went short. So 6 we went long, and then after this bar we were short. And then caught this whole sell-off here.
Nice. Let's look at FTT.
FTT.
Coin of the hour.
Train wreck of the hour.
Whoa. Dude. Nasty. So
Let's see, we were long on the 5th and we went short on the 6th. So we were long here, and here we went short on this bar.
wow. That'd be
And
lucky
then
and good. Wow.
caught this whole bloodbath on the way down, and we're still short.
And our average open price is $22, 22.9,
Yep.
22.94 is
Yep.
average sell price. Wow. And the position size, what's interesting is we've banked half the profit on that trade. Is that because volatility ramped up so much that to keep the volatility targeted position size, we're effectively banking profits?
Yeah, this big bar here is gonna spike the volatility, which is gonna reduce the position size.
So I feel really good about that compared to, say, a traditional trend following system would just let this ride until it hits a trailing stop, right? Like you could easily give it all back. Like
Yeah.
I feel really good about, fuck, we had a great day and now half the profit is already banked. And, even though we're only trading it on a $5,000 account, like this is the behavior that I want to see from my system. Like I couldn't have done it any better if I was on my best day, right? Like, what about you? You're a pretty good trader.
It would be emotionally too difficult.
Yeah.
I think.
And emotionally impossible to do with 80 simultaneous positions, right? You can maybe do it with one on your best day.
Yeah, if you have 85 positions, you can't flip them all from long to short manually. Well, I guess you could, but there would be a lot of work and a lot of very emotional decision making, especially if you have a lot of longs that are looking like they're performing pretty well.
Yeah, and under pressure, your mistake rate. A professional trader should have a mistake rate of about one mistake for every 20 things he does. And under pressure, that probably goes to one mistake in 10. You make 8 mistakes yesterday, and a day like yesterday, 8 mistakes could get you carried out on a stretcher, right?
Exactly. So this bar, you see, it's on 8th November, which is here. And then after this long bar, it cut the position in half.
Really cool, man. Can we look at another couple of these, like that we've got big profits in, to see how it adjusted the what have we got? Our bit perp, or holy perp, either or. Look at you stinking turp. We're in on this way earlier.
This one just kept constant position.
So the volatility has stayed the same. It's just a steady march down.
Yeah, it wasn't that super volatile.
But huge profit, just steady march down.
Yep.
Nice.
TRX.
So now we've increased position size. 7th, 8th, 9th.
So we were long on the 6th. Here we were long and we went short on this bar here.
So it flips almost a little bit quicker than I would if I was discretionarily trading this. So if I was a price action trader, I would probably notice the bar after that and flip short, right?
Yep.
When it's breaking support. It's
It
very
definitely
interesting.
It's definitely more aggressive going short than I would personally be.
Yeah, for me too. I mean, interesting. And
here we do have like a volatility increase here, but then we also have this drop off in the signal. So that
so the volatility increase and the drop off in the signal. So for people who don't understand it, what we're doing here is we're taking an average of all these different forecasts. And so each forecast is in itself a blend of different time period lookbacks for that forecast. So if we're looking at breakouts, we might look at a 50-day, a 100-day, a 70-day, or whatever, and we're blending those together all sort of 30 or so of them to get a combined forecast. And that combined forecast, we're running through a volatility estimation, which we do. Volatility is mathematically quite trivial to predict. And we're getting the perfect position size for the amount of volatility that we want to hold. And volatility is a fancy technical word of saying how much something wiggles. So if it wiggles a lot, it's high volatility. If it wiggles just a little bit, it's low volatility. So when it's only wiggling a little bit, if we want to see our whole account, we target the amount that we want our whole account balance to wiggle. We've decided that we want our account balance to wiggle 25% in the whole year, up or down. That's a simplification, but whatever. And so what Timon is doing is every day he's adjusting the position size for our new forecast, which might change, and we might get more bullish or more bearish, and our new volatility forecast, which might change. We might be predicting more wiggle or less wiggle. If we're predicting more wiggle, we need to hold a smaller position size. If we're predicting more bearishness, we need to hold a larger position size. So those things can counteract each other, which is what has happened, not here, but in the other ones we looked at. That's a fair summary, right?
Yeah, they're actually counteracting each other here, because you can see as the volatility is increasing, the forecast is also increasing.
Nice.
That's why there's no reduction on the increase in volatility.
Dude, this is so cool, man. I can't believe we actually fucking built this. Like, I mean, we set out to do a very difficult thing, right? Like we set out a year ago to do a difficult thing. And boy, it's very satisfying to see it actually work. Like you can't test for something like what's happening today, right? Like you never actually know until you bet real money and the real shit goes down. And you actually, like we set out to build a system that on the worst crypto day in history would make money. That's what we set out to do. And
Exactly.
we've got the worst crypto day in history and we fucking made money. So, dude,
Exactly.
all credit to you, man. Trend following, so good.
Exactly.
Trend following. Oh. So for those who don't know, trend following is the opposite approach than what most people take. Most people are building models of the world, and when that model gets out of whack, they're betting that things return to normal. So like Warren Buffett, he bets that things should be fairly valued, and when they're cheap, he buys them, and when they're expensive, he sells them. His model of the world is that things should be fairly valued. Our model of the world, the trend following model of the world, is that sometimes when models break, they completely break. And when something starts going up, it can go literally to the moon. And when something starts going down, it can go down a lot further than any model is going to predict. And so we're betting on the breakdown of the models. So what that means is that when weird shit goes down, and when the world implodes or some bad shit happens, we're probably, not always, but probably going to be on the right side of that fairly quickly.
Exactly.
And to me, it lets you sleep at night, right? Like if I was running a mean reversion algo or a market making algo on crypto today, I would be extremely, extremely nervous, right?
Exactly. Plus with those strategies, people are usually levered up quite high. So if there's extreme volatility event, it can wipe out your whole account. So
this is an interesting thing. So in technical terms, with positive skew strategies, your higher effective leverage frontier on a Kelly criterion basis is much higher. Like if you can run, like we're running this at less than one-to-one leverage. But if you ran it at leverage, you could run a positive skew system like a trend following system at higher leverage than you could any mean reversion or negative skew system, because those things all blow up, right?
Exactly.
So cool, dude. So the next step for us is we built this whole thing. If we built this based on back tests of crypto data, it's quite obvious that the crypto market changes every single year. And if we built it looking backwards to build something that made the most amount of money for crypto last year, the only thing we could be certain of is that we get it wrong going forward. So we actually haven't done any back tests of this system yet. We built the whole thing out on futures data, which we've got 40 years of 100 markets of futures data. And we started trading it for real before we've actually backtested it. So the next step for us, which I'm really curious about, is what do the back tests look like? Like how much, like now that we know that our costs are reasonable, it uses reasonable leverage, the shit actually works. It works in the worst of times. Like I'm really interested to see a simulation of how it would have worked over the last couple of years. Like to me, that's the fascinating thing that you've got coming up for us on that.
I'd definitely be interesting. Also interesting to know that this system hasn't actually been fitted at all yet.
And so what Timon's talking about is we're blending all of these different subsystems. So we've got each of our 6 forecasts is made up of a number of subsystems, and eventually we're going to weight them. So let's say the longer term trend following works better than shorter term trend following. It gets more weight if it makes more money and it gets more weight. And the other aspect is that if you have a faster system that trades in and out and in and out and in and out, then by definition that incurs more costs. So we have to weight these systems after the costs, and the costs are different on every exchange, right? Like there's no, so there's some work doing. So we can improve this system substantially from where it already is by fitting it exactly to the right costs. So for once in my life, I'm doing everything absolutely professionally and perfect. Like for the very first time, we're not back testing before costs. We're not fitting before costs. We're going to blend all these in the absolute perfect ratio, and all these coins have different correlations to each other. We're going to hold them in different weights. So right now we're just holding equal weights, right?
Our trading signals are equal weight. Our portfolio is not equal weight. We use hierarchical risk parity for that.
Oh yeah, that's right. So do you want to explain hierarchical risk parity, because it's super cool?
I need another cup of coffee before
It's okay.
I go into the math.
I'll give you that. I'll give you the 20-cent version. Is traditionally in trend following systems, you would say, if I'm going to hold the S&P 500 futures, the Dow Jones futures, and the NASDAQ futures, if I hold all 3 of those, they're really the same position because they all go up every day or they all go down every day. So you need to separate them into sectors. You might have equities, you might have energies, you might have soft commodities like sugar, you might have grains, soybeans, and wheat lumped together, and blah, blah, blah. We can't do that with crypto because there's no real sectors, and the ones that are kind of artificial. So Timon's got this sort of cutting edge thing called hierarchical risk parity that runs a correlation matrix over everything and lumps them into buckets iteratively, so that it sort of lumps all the ones that are behaving together similarly, so we don't go overweight any one thing. So all the things that are behaving like crazy shit coins are all lumped into a bucket, effectively called behaving like crazy shit coins. All the things that are behaving relatively similarly get lumped together. That's the rough idea, right?
Yeah, that's correct.
You never know when I start bullshit.
That's a correct description. Yep.
Okay, dude. Yeah, thanks for your time. I think that's all I need. Really cool. Up 1.9% for the day, not bad. There we go.
Nope.
Another big achievement in the books, dude.
Nope.
All right. I love what you're doing. See you, man.
Thanks. Bye.